Welcome to the Deep Dive. Parfums just dropped its Q2 results, and, well, it looked like a bit of a mixed bag on the surface.
Yeah, definitely some push and pull there.
But it actually hides, I think, a really fascinating story of, let's call it, strategic resilience. Today, we want to cut through those headlines. We want to reveal how this fragrance giant is dealing with global economic stuff, headwinds, but also how they're actively, reshaping their future. Everything from tariffs to actually owning brands now.
That's a big shift.
Right. So our mission is simple. Unpack their game plan and figure out what it means for you, the savvy investor.
Let's do it. So looking at the numbers, you're right, it was a bit contradictory. GAAP EPS, that's the official earnings per share number, it came in at 0.99, which actually missed what analysts were expecting by about 9 cents, roughly 8%.
Not insignificant.
No. But then revenue, that landed at $333.94 million, and that was pretty much in line with what everyone thought, even though it was down 2% compared to last year.
So a little wobble on the bottom line, earnings, but the top line, sales, basically held steady.
Exactly.
And here's where it gets really interesting for you listening. Because even with that small dip in revenue, Parfums showed some real strength where it really counts. Gross margin.
Big jump there.
Huge jump. An expansion of 170 basis points year over year. That hit 66.2%. Now 170 basis points, that's 1.7 percentage points.
Right.
And getting that kind of lift, especially when sales are a little soft, that tells us they're fundamentally tweaking their brand mix, their supply chain, optimizing for higher profit.
That's key, especially in luxury, which can be pretty sensitive to economic shifts.
Absolutely.
And what's really compelling, I think, tying into the overall health here is the operating cash flow. Massive turnaround.
Tell us about that.
Well, they went from actually consuming $26 million in cash in the first half of 2024.
Okay, burning cash.
Right. To generating a positive $5 million in the first half of 2025. That's not just, going from red to black.
It's more fundamental.
It gives them autonomy. It means less reliance on banks, on financing. They can fund their own moves, like acquisitions, without necessarily issuing more stock or taking on expensive debt.
That's a powerful position to be in. And despite all this, moving parts, the company actually reaffirmed its full year 2025 guidance.
They did, still projecting sales at $1.51 billion and EPS at 5.35 cents.
That's a pretty bold statement of confidence, isn't it? Suggests management feels they know how to steer through these current choppier waters.
Yeah, they seem to have a clear view. Now, the market reaction was interesting. It dipped initially, maybe 2% right after the numbers came out.
I saw that.
But it bounced back really fast, closed pretty much flat on the day. What caught my eye, though, was the volume. Trading volume spiked, nearly double the average.
Okay, so lots of activity. What does that signal to you?
It signals active engagement. Investors are paying attention, maybe not panic selling, but definitely a keen interest in understanding these strategic shifts and, the real health underneath the headline numbers.
Exactly. So what does this all mean for your understanding of Parfums? That's our mission today. Let's unpack these numbers, dig into the strategic choices they're making, assess the outlook. Let's dive right in.
Sounds good.
Okay, let's start with that impressive gross margin performance. How did they manage that 170 basis point gain, that 1.7 percentage point jump, even with revenue slightly down?
Yeah, it wasn't just luck. It was really a combination of smart moves. Management pointed to a favorable brand and channel mix, meaning they sold more of their higher margin stuff, their pricier brands, and sold them through channels that give them better profit, like maybe direct to consumer or certain retailers. And crucially, phasing out that Dunhill license, especially in the US. That probably trimmed a bit off the top line, the revenue, but it clearly boosted the quality of their sales, the profitability.
Okay, that makes sense. But improving gross margin, sometimes that comes at a cost elsewhere, right? Did we see that in their other expenses?
We did, yeah. You're right. While gross margins looked good, their advertising and promotional spending, A&P actually grew 5%, hit $120 million.
Wow.
Which is about 18% of their first half sales. So that shows a very deliberate choice. They're investing, pushing hard to support new launches, even though wholesale trends are a bit soft.
Doubling down on marketing.
Exactly. And at the same time, SG&A expenses, that's selling, general, and administrative costs, they also ticked up, reached 48.5% of sales for the quarter.
So optimization at the gross level, but then strategic spending below that, which squeezed the operating margin a bit.
Precisely. It's a trade-off, investing for future growth versus maximizing current profit.
But the good news for you, the investor, is that balance sheet. It still looks incredibly strong.
Rock solid.
They're sitting on $205 million in cash equivalents, short-term investments, and their working capital, basically, their short-term financial flexibility is strong at $654 million.
Yeah, and that kind of financial muscle is exactly what you need to support those strategic moves, especially when the global economy feels a little, uncertain.
Absolutely essential.
And that flexibility you mentioned, that's what allowed them to take out a loan recently.
Okay, why the debt?
Primarily to fund asset purchases. Things like the Goutal acquisition, which is a niche luxury brand, and also buying more office space in Paris.
Use of leverage.
Seems like it. It shows a pretty conservative approach, actually. They're not just relying on the cash they generate day to day for these big strategic plays, but they're using their strong balance sheet intelligently.
Okay, speaking of external factors beyond their control, currency. We've seen crazy swings lately. Yeah. Did that bite them?
It definitely had an impact. If you look below the line, so outside the core operations, yeah, they took a hit. A $2.4 million loss from foreign exchange.
Ouch.
And another $3.4 million loss on marketable securities in the first half. The main culprit was the Euro-USD exchange rate. It went nuts.
How so?
It swung from about $1.03 per euro in early February all the way up to 1.17 by the end of June. That kind of volatility definitely makes international business tricky, something to keep an eye on.
For sure. So strong internal management, optimizing things, but facing some of these external headwinds.
Yeah.
What's the CEO's overall take? How do they see the market right now?
Well, connecting this to the bigger picture, management said that while U.S. demand is still strong,
good sign,
global fragrance growth overall has begun to ease. They expect these headwinds, this softness, to stick around to the second half of 2025.
Okay, bracing for a tougher H2.
A bit. But they also expect these challenges to be, quote, fully resolved by 2026. So there's this forward-looking view, plus the reaffirmed guidance. It suggests they feel they have a plan to navigate this and get back to more normal growth.
Interesting. Okay, let's dig into where the sales are happening. That regional performance for the first half wasn't exactly even across the board, was it?
No, far from it. Some real bright spots, actually. North America was up 7%, Western Europe up 3%, Central and South America up 7% too.
Solid growth in key areas.
Yeah, driven by brands like Lacoste and Coach, especially in the Americas. And Eastern Europe had a really strong showing, up 14%. They seem to have overcome some sourcing problems they had there last year.
Okay, so good news there.
Yeah.
But where were the struggles?
Asia Pacific was the main weak spot for fragrance sales, down 12%.
Why the drop?
Mostly because they had incredibly strong sales in Australia last year, making the comparison tough, plus ongoing challenges in South Korea. Though they did say China and Japan showed more favorable trends.
Right. Any of the weak spots?
The Middle East and Africa region, down a significant 19%. That was heavily impacted by getting rid of that Dunhill license we talked about.
The base effect.
Exactly. If you strip out Dunhill, sales were still down 6% in that region. So it really highlights just how varied the global picture is right now. Regional issues definitely matter.
Beyond just sales figures, though, Parfums seems really busy on the strategic front, expanding the brand portfolio. Big news with Longchamp, Brett.
Huge news. An exclusive fragrance license for Longchamp, the iconic French fashion house. First launch plan for 2027. And get this, no upfront fee for the license.
Wow, that's a coup.
Absolutely. A fantastic win. Lets them add a major name without a big immediate cash outlay. And this comes after adding Off-White recently and buying Goutal.
They're really building out that portfolio.
And what's maybe even more exciting is their move into owned brands.
Colverino.
Exactly. Their first owned brand. They're opening a flagship boutique in Paris next month, launching e-commerce. They even had a recent introduction at Selfridges in London.
So this isn't just adding another license. This is different.
Totally different. It signals a real strategic shift towards premium, artisanal luxury, more control over the brand, the story, the margins. Plus, they mentioned they have capacity to add more brands.
So the ambition is high.
Seems like it. They're almost building their own little luxury group within the fragrance world. Plus, they've got new stuff coming for Jimmy Choo, Mont Blanc, Karl Lagerfeld, Lacoste. The pipeline is full.
That's a fascinating move. And it probably ties into their broader distribution strategy, especially online. How's e-commerce looking?
Looking strong. Good momentum there. Amazon, in particular, is growing at a double-digit pace for them.
Okay.
They're also expanding on platforms like Divabox. That's the #2 fragrance e-com platform in France. And Inter Parfums actually owns 25% of it.
Interesting integration.
Yeah. And they're getting onto newer channels like TikTok Shop. For platforms like TikTok, they're even creating special programs like smaller sizes, lower price points to kind of match what those customers expect.
Adapting the product to the channel. Smart.
Very agile approach.
Yeah.
Meeting the customer where they are.
It really sounds like they're examining every single piece of the chain. What about the less glamorous stuff? Logistics, sourcing? Yeah. Any big changes happening there?
Definitely. On logistics, they're moving out of their Dayton, New Jersey facility, transitioning to a new setup with a third-party logistics partner. That should be done by the end of Q3.
Aiming for efficiency gains there.
You'd assume so. It's a big operational change. And on sourcing, this is really proactive. They've started shifting component sourcing, plastic caps, pumps, metal bits away from China.
Why the shift?
Primarily to minimize the hit from U.S. import tariffs on those components. They're looking for alternative suppliers and also trying to produce more locally where it makes sense, de-risking the supply chain.
Speaking of tariffs, there's actually been some good news, relatively speaking, on that front, hasn't there? How does that updated picture affect them?
Oh, this is huge for them. A really significant positive development. An agreement was reached to keep tariffs on goods coming from Europe at 15%.
Better than feared.
Way better. Earlier projections were talking 30%, maybe even 50%, plus potential retaliatory tariffs going the other way. And even better, tariffs on U.S. exports to Europe are set to be eliminated entirely.
Wow.
Plus, they mentioned preliminary deals with China, South Korea, Vietnam, the Philippines. It all just adds up to much greater clarity and stability on trade. For a global company like Inter Parfums, that's a massive relief.
Takes a big uncertainty off the table.
Yeah.
And how are these tariff changes and maybe other costs filtering down into their pricing? What's the strategy there?
Well, this clearer tariff picture directly feeds into how they price things. They're being selective, though, not just a blanket increase.
Oh, so.
They're going with more aggressive price hikes, mid-single-digit percentage increases, specifically in the U.S., because that's where the tariffs have the biggest bite.
Okay.
But in other markets, they're generally holding the line on entry-level pricing for smaller sizes.
That's smart, right?
Keeps the door open for new customers.
Right. Don't price people out immediately.
Exactly. But larger sizes or brands where customers are maybe less price sensitive, those will see more significant price bumps. Overall, they're expecting about a 2% average price increase across the board, rolling out gradually through the end of the year.
Okay, looking ahead now. The next few months, Q3 leading into Q4, absolutely critical for the holiday season. Management mentioned this ongoing issue of retail destocking. Can you unpack that?
Yeah, basically, distributors and retailers are being cautious. They're keeping their inventory levels lean.
Not ordering as much up front.
Exactly. So sell-in, what Inter Parfums sells to those retailers, is lagging behind sell-out, what the retailers are actually selling to end consumers.
But the crucial point seems to be that end demand, what people are actually buying, is still healthy.
That's what management is saying. End demand is healthy, and they believe they've actually gained market share. So the underlying consumer appetite is there.
Which creates an interesting dynamic for the holidays.
Potentially a challenging one. They're actually preparing for a possible big surge of orders late in the season, maybe even into early December, as retailers scramble to restock if that end demand holds up.
Puts pressure on logistics, manufacturing.
Big time. But despite that potential crunch, the company sounds confident they'll hit that full-year guidance. They're banking on those price increases driven by tariffs, maybe some help from foreign exchange rates, and expecting these broader challenges to smooth out by 2026.
Cautious optimism, maybe. Relying on strong consumer pull-through.
That seems to be the narrative, yes.
Okay, let's switch gears slightly and look at the investor context. What's the market sentiment here? Because despite reaffirming guidance, the stock itself hasn't exactly been lighting it up recently.
No, it definitely hasn't. It's lagged its sector ETF, the XLP. If you look at one-month returns, Inter Parfums was down about 4.7%, while the XLP was only down 0.5%.
Ouch.
And the three-month picture is even starker. Inter Parfums down over 15% versus the XLP down just 1.6%.
So what does that divergence tell you?
It suggests investors are pretty skeptical right now, taking a definite wait-and-see approach.
Waiting for proof.
Exactly. Waiting for concrete evidence that the second half reacceleration they're projecting is actually going to happen, especially with all this noise around destocking and tariffs. Management talks about a 2025 margin quality reset and 2026 normalization as inventory gets right-sized and these new brands start contributing.
But the market wants to see it first.
Pretty much. So for investors, the upcoming holiday season results and how well those new luxury brands like Solferino and eventually Longchamp perform, those are going to be absolutely key catalysts to watch.
All right, it is time for our This Is Not Financial Advice segment, where we throw out an outrageous but maybe plausible trade idea. These are fun, of course.
Absolutely. Purely hypothetical, definitely not advice, just a thought experiment based on everything we've discussed.
Okay, so given the market's current caution, that lag we just talked about, but if management really pulls off this second half acceleration, if they get the inventory sorted for 2026, here's a speculative idea for the patient investor out there. It's a play on a potential re-rating down the line.
Right. You could think about a long-term call spread. Now, this is a specific option strategy.
Explain it simply.
You buy a call option, which gives you the right to buy the stock at a certain price, the strike price. But at the same time, you sell another call option with a higher strike price. Both have the same expiration date way out in the future.
So for inner Parfums,
You might look at buying, say, a January 2027 call option. Strike price may be a bit above where the stock is now, perhaps $120, and then you'd simultaneously sell a January 2027 call at a higher strike. Let's say $140.
okay, what's the point of doing that?
Well, selling the higher strike call brings in some premium, some cash. That reduces the cost of buying the lower strike call. So your upfront investment is much lower than just buying the $120 call outright.
What's the catch?
The catch is you cap your potential profit. If the stock goes way above $140 by January 2027, you don't capture all that upside beyond $140. But it significantly reduces your risk, your cost to put the trade on.
So it's a bet on a solid move higher, maybe back towards that $140 level or beyond, but not necessarily a to-the-moon scenario.
Exactly. It's a calculated play. Betting that if those new luxury brands like Longchamp and Solferino catch on, if the tariff and FX tailwinds really kick in as the macro noise fades, the stock gets re-rated higher. It rewards patience.
Interesting idea. Again, not financial advice.
Not financial advice.
Okay, so let's wrap this up. Parfums navigated a pretty complex second quarter, showed some real chops on margin execution, significantly improved that operating cash flow.
Yeah, despite the headline EPS miss and that slight revenue dip, they're clearly in the middle of a strategic reset, making deliberate choices.
And that reaffirmed full-year guidance. It really hinges on delivering a stronger second half. They're counting on strategic pricing, integrating these new brands, and getting some help from favorable currency moves.
Market sentiment is still guarded, hesitant, as we saw with the stock performance, but the proactive steps they're taking on tariffs, on sourcing, expanding e-commerce, plus that exciting pipeline of new luxury stuff, it does point towards a potential turning point if that second half story plays out.
So the critical question for you, the listener, is really, how does this holiday season actually shake out? Especially with retailers keeping those inventories so lean. Can Parfums operations handle a potential late surge in orders?
And will that pave the way for the normalization they're projecting for 2026? It's less about just the Q2 numbers now and much more about watching the execution of their strategy going forward.
It's a fascinating situation to track. Thank you for joining us on this deep dive. And please remember, this deep dive and its contents are purely for informational purposes. They do not constitute financial advice.
Always do your own research. Consult with a qualified financial advisor before making any investment decisions.
We look forward to our next deep dive with you.